morning, everyone. My name is Catherine, and I'd like to start by thanking you all for joining us today for what will no doubt be a very informative session on planning your retirement. I'm very pleased to welcome Nick Hathaway and Jamie Ellis from Durham's Financial Planning, who will take us through the presentation shortly. Just before we begin, a little bit of housekeeping. Today, you are all joining in listen-only mode, which means your webcams and microphones are automatically disabled. If you would like to ask us a question as we go through the presentation, please use the Q&A box. There is an option to tick the box if you would prefer to ask your question anonymously. I just want to let you know that this session is being recorded and a copy will be made available to you over the coming days. That's all from me now. I'm going to hand over to Jamie, who will take you through the presentation. Jamie, thank you very much, and over to you.
Hello everyone, and thank you, Catherine. I'd like to just thank everybody else for being with us this morning on our webinar titled "It's Never Too Early or Too Late to Plan for Your Retirement." My name is Jamie Ellis, and I'm a financial advisor here at Durham's. And we understand that pensions are full of complexity, jargon, and myths. And we hope that you walk away from this presentation feeling educated and wishing to improve your future financial situation. So this presentation caters for individuals, employers, and business owners, as the general planning principles remain the same. However, later in the presentation, my colleague Nick Hathaway will be providing business planning opportunities for company owners as well, if that includes you. So a bit about Durham's Financial Planning. We are fully independent financial advisors, which means we have access to all of the products and investment solutions across the market. And this means that we can recommend appropriate solutions and products when making recommendations to our clients. We are directly authorised by the Financial Conduct Authority, meaning we have to adhere to minimum qualification requirements and ongoing professional development. We now look after more than £110 million of our clients' funds, and we have a really robust investment process, which Nick will discuss later in the presentation. But we're really in a privileged position to be custodians of our clients' wealth and looking after that amount of assets under management. Last year, we were awarded top-rated advisor status in the Times newspaper, which is a fantastic accolade, which we like to shout about. And the reason why that's so important to us, it was based on real client feedback and independently verified as well. So yeah, it's a genuine award within the industry. And the advice that we deliver is not just verbal advice. We use leading industry technology and software, such as investment research software, pension software, and a firm favourite of mine is cash flow modelling software. So this allows clients approaching retirement or business owners to really visualise how the decisions they make now may impact their future financial situation. And I've recently written an article on this, which is to be published next month in Midlands Insider, and I'm sure that Catherine will be sharing that across our social channels. So if you are a business owner and you want to know how to manage your wealth pre and post business exit, then please do look out for this, or pop me an email and we can send that through in due course. We do like to work closely with our clients and their professional connections. Many of you on this call will be clients of the Durham's accountants upstairs, and we like to work closely with them to deliver holistic financial planning to their clients and to our clients. And we also involve other professional connections such as solicitors for other types of work as well. So you're here today to learn a bit more about retirement, and one of the main planning vehicles in retirement is a pension. So what is a pension? A pension is a type of income you get when you retire, and generally there are two types of pension arrangements. Firstly, you have a defined benefit pension, which is otherwise known as a final salary or superannuation pension. And this is set up by the employer to provide a set benefit each year when you retire. The employer takes all of the investment risk, and at retirement or normal retirement age, it will provide you with an indefinite income for life, which is a set benefit each year. Now, this will normally increase with inflation, and it may have spousal pensions attached to it, so they're really valuable pension schemes. The risk to the individual with the pension is really limited, and it's just the risk is really that the employer cannot fulfill their obligation to provide your income, at which point the liability will then fall onto the pension protection fund, which effectively acts as a lifeboat. Now, you'll find these pensions within the NHS, teachers' pensions, local government authority also, but as they are becoming increasingly aware, today we're going to be focusing on defined contribution pensions, otherwise known as personal pensions. Now, with a personal pension, you aim to build a pension fund for you to draw from at retirement. The investment risk resides with you as the individual, so you're responsible for investing the funds, although a lot of workplace pensions will just put you into a default strategy. You can contribute to this fund, your employer will contribute also if it's a workplace pension, and the government incentivises long-term savings by providing tax relief. And ultimately, when you do come to retire, the fund will last as long as the income that you take from it is supported. So if you've got £100,000 in your pension fund, but you draw 100,000 out over 5 years, assuming there's no capital growth, then you've obviously eroded your pension fund, which is not similar to the defined benefit pension, which would provide an indefinite income for life. Okay. The key risks are obviously that your fund runs out. So this is why it's so important to review what you have, ensure that it's working for you so that you can maximize the fund up until the point that you retire. And then when you do retire, it's all about drawing the money out in a tax efficient manner. So Nick will later explain how we assist clients in maximizing their fund during the accumulation years when you are paying in. But at retirement, we also work with clients from the day they may finish work or sell their business to the day that they unfortunately pass away. And it's all about how to draw money out from the pension tax efficiently. So one thing about pensions is, as you may be aware, you can draw 25% from the fund as a tax-free cash. And a lot of individuals think they'll get to retirement age and withdraw the 25%, but really there's not much point in withdrawing the 25% if that fund is then going to be sat in your bank account earning next to nothing when it could be invested in the pension wrapper, still providing investment growth, and it grows within the wrapper free from capital gains. So it is a case of educating clients in that respect and letting them know what the best things to do are at retirement. So let's assume you've reached retirement age and you have a pension fund value of £420,000. So let's assume that you retire at age 50, you have no other income aside from your state pension, which will commence at age 67. Now, simply put, a pension can be looked at as two separate bank accounts. One bank account is tax-free, which is a 25% side. So in this case, it's 105,000 in the tax-free account and 75% in the taxable account. So as a minimum, what we would be looking to do for this individual or yourself, if this was your pension fund, we would look to ensure that every year you draw out £12,570 from the taxable side, as this is the amount that you can earn each year without paying any tax. So this is within what is known as the personal allowance. So it's 0% tax up to that point. Now, because you're drawing that equates to 75% of the taxable pot. So the remaining 25% of that figure is £4,190. And that would be crystallised from the tax-free side. So in essence, in year one, you can draw £16,760 completely tax-free from the pension fund, which is a fantastic piece of planning. We always advise that when you draw an income from an invested fund, that over the longer term, 4% is a sustainable rate of drawdown. And we would assume that investment markets would grow at 4%, or an investment strategy would grow at 4%, which would effectively support and replace the income which you're drawing from the fund. So here you can see the additional growth is added back on and the fund value remains the same. Now, pensions are completely flexible, and in the second year, you may wish to do the same again to get the £16,760 out tax-free, but you may have other home renovations or a need for an immediate tax-free lump sum. You may wish to get the kitchen replaced or the driveway done. So what you can do is you can draw then from your tax-free side £40,000 tax-free. And while this would crystallise the £120,000 in the taxable side, this £120,000 would not need to be taken, and effectively that could be left to grow to support your income at a later date. So here we show an example of how £56,760 could be taken in year 2. Obviously, if you needed more money from the taxable side, you will have to pay tax at your marginal rate of income, but it just goes to show how we can draw from the fund very flexibly, and it makes pensions a brilliant savings vehicle. Okay, so as a savings vehicle, a pension provides probably the best opportunity to maximise your long-term savings. And as they are so advantageous, the government does impose a series of allowances and reliefs on how big your fund can grow. Now, while there is no limit on how much you can be saved into pensions each tax year, there is a limit on the amounts that can qualify for tax relief. Okay, so the amount of a personal contribution that can currently be paid in is £40,000 per year, or 100% of your salary. You can actually use your annual allowance from the previous 3 tax years, assuming you have been a member of a registered pension scheme. So it is possible in certain circumstances that you can save £160,000 into a pension in a single tax year. So that's for business owners who may be approaching retirement, it's a very good way to get that immediate boost into your pension fund. So the issue with carry forward is, though, again, if it's a personal contribution, you would need the salary to support that level of contribution. But for employer contributions, there is absolutely no link to earnings whatsoever. And while it should satisfy the wholly and exclusively test, employer contributions can be made, which will benefit from corporation tax relief, as effectively they're treated as a tax deductible business expense, which we will cover later. Now, the lifetime allowance for pension funds, which is the maximum amount you can save into a fund without triggering a tax charge, is £1,073,100. Now, it looks like a relatively strange number, but back in 2012, the lifetime allowance was 1.8 million. Over the years, the government has slowly reduced that, and then it started rising again with inflation, which is why we have this nominal figure here. The lifetime allowance has been froze until 2026. So we are seeing more and more clients breaching this lifetime allowance, especially considering the investment returns that we've had, which have been quite phenomenal over the past 10 years or so. So what are the tax advantages of paying into pensions? So as pension tax relief makes it more attractive to save for the future by giving you more for your money now. So the tax relief that you receive is paid at the highest rate of income tax. So effectively, if you pay higher or additional rate income tax, then the benefit of paying into a pension is much greater than somebody who is a basic rate taxpayer, but it's still massively effective. So simply put, for a basic rate taxpayer, they would pay £80 into a pension. The government would provide £20 in tax relief, meaning the total contribution would be £100 into their fund. For a higher rate taxpayer, they would still pay in £80 into their pension. The government provides 20% tax relief, but then they can also reclaim the higher rate tax relief of a further 20%, which means that for a net contribution of £60, they have £100 paid into their pension. And let's be honest, you will not get that type of immediate uplift that is risk-free anywhere else. So pensions provide an amazing vehicle. For employer contributions, Nick will cover this later, but there's zero income tax, no employer national insurance. The employee doesn't pay national insurance on the income he would have otherwise received if he operate by salary sacrifice. And as it's an allowable business expense, there's no corporation tax at 19%. When the funds are within the pension, they grow completely tax-free. There's no capital gains tax on the money held within a pension, so it can grow free of tax. And as we showed earlier, 25% of the fund is available tax-free. And because of these generous tax incentives, the fund is available from age 55, but this is increasing to 57 from 2028. So the government is trying to remove the reliance on the state and has shifted the onus onto individuals and employers by way of introducing auto-enrolment. Now, this was introduced in 2012 for the largest organisations and was rolled out, but by 2018, every organisation now has to enrol eligible employees into a qualifying scheme. The eligibility criteria for an employee is they have to earn more than £10,000 or be over the age of 22 or under the age of 67. Now, it is really important that you're aware of your obligations if you are an employer, as if you don't comply, you can face fines of up to £10,000 per day. So if you've got any queries on auto-enrolment, the government are currently fining a lot of limited companies and other organisations. So if you're unsure of your obligations, please don't hesitate to get in touch with us, and we can just ensure that everything you're doing is the most efficient and tax effective way. So auto-enrolment, the minimum contribution basis is the employee has to pay 5%, which is currently can be made up of 4% for a basic rate employee. They then receive 1% tax relief and the employer pays in 3%. So an employee who pays £100 net would have tax relief of 25 also paid in, and then their employer would pay a further £75 into their fund. This means that for £200 into Joe, in this example, his pension, he would have £200 paid into his pension from an effective net contribution of £100. Again, you're not going to see that level of immediate uplift anywhere, no matter what investment you may consider. So we would always advise clients that if they are employed, to at least match the minimum level of contribution that is being offered by the employer, as this is really the only opportunity in life you will have to get free money. Okay. So Joe earns £30,000 and he pays in the minimum. Here we can show what his fund would be likely to grow to over a period of 35 years. So this assumes that he earns £30,000 throughout, and his fund achieves 5% net per year. Okay, this is just for presentation purposes, and investment markets can obviously go up and down. But what we can see here is Joe would have contributed £42,000 over his lifetime, which is his net cost. But the fund actually grows to provide a fund of £263,000 at age 57. Now, when Joe comes to draw from the fund, again, we say that 4% is probably the optimal and sustainable rate of withdrawal from an invested fund. And this could provide Joe with an income of £10,500 in retirement. What this doesn't factor in, however, is the impact of inflation. And we've seen inflation running at around 3.5%. There are concerns that the figure could be quite a bit higher when considering other asset classes. So we would estimate that this £10,500 in today's terms will only be worth £6,500 when Joe reaches age 57. So that's why it's so important to invest, not only to achieve growth, but to ensure that your money retains its real value and tracks inflation and hopefully achieves something over and above. So when is the right time to pay into a pension? Well, the sooner the better. And here you can see a fund that is invested for a further 10 years, and it works both ways. So if Joe was 32, he could have been contributing 10 years earlier. And in this example, he's contributing for a further 10 years. But we can see that the fund increases by a further 70%, nearly £200,000, just by contributing for a further 10 years. And the reason why it grows the longer it's invested is due to compound growth. And you can see that this chart gradually gets steeper and steeper as time goes on. And the reason is, let's say Joe's fund value is £1,000 in the first year. He achieves 5% growth, which will provide £50. Now, it's not exactly that exciting. It's not blowing the lights out, but that 5% when Joe comes to retire, based on a value of £440,000, would actually be 22,000. So you can see that as the fund grows and the percentage returns actually equate to a larger monetary figure of growth each year. And it's not just how long your fund is invested. Again, Nick will discuss in greater detail where we invest our clients' monies and our investment process to ensure that your fund is doing what it should be doing and is going to provide you with an optimal outcome at retirement. Again, 4% income based on this would be £17,624, or in today's terms, £8,940. So it's always important to consider the impacts of inflation and how that can impact your savings at retirement. So the question is, and you probably sat there thinking, am I saving enough to have the retirement that I want, to fulfill the lifestyle that I want, to do the things I've always wanted to do, and when can I retire? So one myth that people have is that the state will provide for me. And the facts are that the Pension Living Association have recently done a study, and they found for a single individual, an income of £20,800 would be required at retirement to provide a moderate lifestyle. Now, a moderate lifestyle in their definition would be to provide one foreign holiday per year and maybe to eat out a few times a month. For a couple, that is estimated to be £30,600. But let's be honest, your lifestyle and Joe Bloggs next door could be completely different, and you may deem moderate lifestyles completely differently. What we can see, however, is that the full state pension, every year you work, you earn national insurance, you pay national insurance, and you accrue a national insurance contribution history. Assuming that you have 35 years of full national insurance at retirement, you will be eligible for the full state pension. And that full state pension currently provides £9,339 per year by way of an income. So you can see straight away that the state pension would not provide a moderate lifestyle for a single individual. And when you combine two lots of state pension for a couple, you're still some way off. People think that the state pension isn't a valuable benefit, but when you actually look at the cost of, let's say if you had a fund and you wanted to buy an increasing income, which is equivalent to the state pension each year of £9,339 per year, what do you think the cost would be? And this is the cost to the government effectively. The cost to provide an equivalent state pension from a fund would be £335,000. So yes, it's a very valuable benefit and one that, it's just very valuable. And when we plan with clients for retirement, some clients don't like to consider the state pension in their retirement affairs. Some do. Ultimately, we don't know what is going to happen with the state pension. As people are living longer, we can probably expect that the state pension age will gradually increase. But these are all assumptions that we factor in when we are dealing with clients. Okay, so back to the question, are you saving enough? The general rule of thumb is that 12% of your earnings over a 50-year period would provide a comfortable lifestyle in retirement. This obviously does include employer contributions and tax relief that you may get from their employer. And if you do wish to check that you're on track, then don't hesitate to let us know and we can review your affairs and what you are wishing to achieve in retirement. And truthfully, without an understanding of these things, what your expenditure may be in retirement and your anticipated lifestyle, we can't provide you with an answer as to, are you saving enough? We need to dig under the ground, get under the hood, and think about what is important to you and what sort of retirement you would like. I find it genuinely interesting that so many clients come to retirement and we sit down and they don't have a solid grasp on what their expenditure is. And we'll go through a full expenditure breakdown, because ultimately a lot of clients think that they'll retire and spend less money as their mortgages and other liabilities are paid off. But because individuals and couples have time to do the things they always wanted to do, whether that's holidays or social activities, we generally find that they do spend more when they come to retire. So we pay great attention to our clients' personal and financial situation to obviously gauge whether, if they are saving, is enough. And what we would always say to clients is it's never too early or too late to save for your retirement, but obviously the earlier that you start, it means that you don't have to make massive intentional changes as you may be 50 or 54 and you're approaching retirement. So the earlier you start planning, the better. And as part of our service, we actually have regular reviews with clients where we can build cash flow models, considering all of their assets and income, if they've got buy-to-let properties or other investments that are income generating. We can build all of those into a really visual display to show them what sort of income they can have in retirement and show them whether they can meet their lifestyle. So another question that we raised in the presentation and people wanted to know is what happens when you leave your employer? So if you are an individual and you leave your employer, your plan effectively becomes paid up. And what that means is your active contributions into the pension will stop, and so will your employer's. The pension does remain invested, but probably in a default fund. So it's important that this is reviewed to ensure it's appropriate for your situations. At which point you then have three options. You can leave it, you can transfer it to your new employer's workplace pension, or you can transfer it elsewhere to a more dynamic pension where there's more options. One thing we would say is never transfer a pension without reviewing this firstly. And the reason is some pensions do have valuable benefits, or an industry term known as safeguarded benefits, which means that they may have guaranteed growth rates, guaranteed annuity rates, or protected tax-free cash. So we would always review any individual's pensions if they did wish to consolidate them. And why should you consolidate your pensions? So firstly, the average individual has 11 jobs by retirement age. And to ensure that your funds aren't misplaced or effectively lost into the ether, where you can't track them down, we always advise clients that they should simplify their affairs. Your pension is likely to actually be your largest asset at retirement, and in most cases it's more valuable than your main residence. So it is important that you do review these annually to ensure that they are working for you and providing an optimal outcome when you do come to retire. Here at Durham's Financial Planning, we offer a free location service for your pensions. So if you could provide us with your employment history, we can write to the respective providers, or if you've got paperwork, the better. We can then review them in terms of cost, risk and performance in line with your situation and objectives, and look to potentially consolidate them into one more dynamic arrangement. And the one thing I would say is we are directly authorised by the Financial Conduct Authority. So anything we do has to be in your best interest and provide a greater level of financial outcome, well, a more optimal outcome. So we wouldn't be recommending that you transfer if it wasn't in your best interests. Okay. Finally, it's not, although this presentation is about pensions, it's not just pensions that we consider when we sit down with clients. We are conscious individuals and business owners will have their business where they may be drawing dividends and salary from. They may have a pension, they may have an ISA and other investments, collectives, venture capital trusts, EISs and bonds, and all could deserve a presentation in their own right. But it's just to say that we're not just pension experts, and we consider retirement planning, inheritance tax planning, everything we do is to provide a holistic planning service. And we can turn on these levers when you come to retire to provide a really tax efficient income at retirement. We do work with individuals, families, and also small and large business owners. And while financial affairs can be more complex for the wealthier clients and the business owners, the general planning principles are all the same. So that's the first half of the presentation complete, and I'm just going to hand over to my colleague, Nick Hathaway. So I'm just going to end my slideshow. I'm just going to stop sharing my screen and hand over to Nick. Thank you, everyone.
Thank you, Jamie, and good morning, everyone. Thanks for joining us. My name is Nick Hathaway, and I'm one of the financial advisors here at Durham's Financial Planning. I'd like to start by looking at some of the considerations surrounding making pension contributions for business owners, and then I'll go into some of the more complex areas a little later on. So let's consider an example. This will be very familiar to any of you that are business owners, but the rather imaginatively named ABC Limited has £50,000 within the business, which the director wants to extract. One method of doing this might be to take it as salary, the benefit of this approach being that salary is a business expense. However, you're then going to suffer employer national insurance, employee national insurance, and also income tax at up to 45%. So that would leave you, of that £50,000, with a sum of £31,982. For this reason, a lot of company directors will turn to dividends, which you may know have lower rates of tax attached to them. You can benefit from the £2,000 dividend allowance as well. However, dividends have to be paid from post-tax profits. So before a dividend is paid, you'll have already suffered 19% corporation tax. And then once the dividend is received, you'll again be subject to income tax, albeit at lower rates. So of that £50,000 through dividends, you would be left with £38,555. In reality, business owners will use a combination of these two approaches to take advantage of various allowances and thresholds, but this just goes to show that a decent proportion of that profit or revenue will be lost to tax and national insurance. And this is where pension contributions come in. A pension contribution is a business expense, so it benefits from 19% corporation tax relief. And then you have flexible access to that pension from 55. So of the £50,000 figure we see on the left-hand side, all £50,000 would be paid across into a pension. And if pension contributions weren't already the best solution for taking money out of a business, there's been a number of recent reforms which strengthen the case even more. Chancellor Rishi Sunak has introduced the health and social care reforms, which increased national insurance by 1.25% for both employers and employees. This is going to be collected through national insurance for a year, but then it's going to become a standalone tax in its own right from 2023 onwards. And just because it's not possible to get one up on the taxman and get round these new taxes, they've also increased the dividend tax rate by 1.25% as well, just to prevent people sort of avoiding the health and social care levy that way. So both of these measures result in an even further reduction to the net figures that we saw on the previous page. So that £50,000 would be dwindled down even more through these new levies. And if that wasn't enough, corporation tax rates are increasing from 19% to 25% for certain businesses. Those with profits under 50,000 are likely to see no impact, and those with over £250,000 in profit will be charged at the full rate. And there'll be some impact between those two figures if your company has profit between those two levels. So this just makes pension contributions even more valuable, particularly in light of that corporation tax change. If you want to look at it in this way, you could consider that the taxman is potentially putting in 25% of every pension contribution you make. So that brings us on to maximising your fund, which is one of the themes of the webinar. So what do we mean when we say maximising your fund? Really, we're looking at ensuring your pension is invested in the best way with the highest likelihood of long-term growth and invested using a strategy that you're comfortable with. Over a long time frame, even an extra 1% per year of investment growth can have a really big impact on the value of your pension fund at retirement. And that's ultimately going to impact how much money you have to live on and how much you enjoy your retirement ultimately. So it's really vital that you take a grasp of your pension fund as early as you can, particularly how it's invested, and then consider if there's any better solutions available. Almost all of the new clients we meet find that they have benefited from reviewing how their pensions are invested, even if it's just a case of tweaks, not moving it anywhere, just tweaking how it's invested. But it's also always something that we're keen to review for clients. So we can review your existing pensions and consider if they're invested suitably, if the costs are reasonable, and if any improvements can be made to ensure that you're going to meet your objectives in retirement. We don't charge for this initial review, so do get in touch if you'd like to know more about this. So this slightly ominous graphic on the slide is showing the performance of global stock markets over the past 50 or so years. The detail isn't too important, but what you will notice is the volatility, the huge ups and downs over various periods. There's some notes in there showing some fairly big global events, the coronavirus pandemic, the financial crash, and the dot-com bubble. But if you're some way off retirement, this need not really worry you. As long as the general trend is upwards, you can be assured that your pension funds are growing and that the occasional dip or stock market correction isn't going to impact you too heavily. In fact, if you're making regular monthly contributions to a pension, falling markets means falling prices, and that just results in you getting more bang for your buck with this month's pension contribution when you compare it to last month's. However, someone due to retire in, say, a year or two is rightfully going to be much more concerned by turbulent market conditions and a fall in the value of their pension fund, as this might impact their plans for their soon approaching retirement. So most pensions that are started today will be invested over a 30 or 40 year time span, which means that regularly monitoring and adjusting the pension is really important if maximising the fund is what you want to do. It's for this reason a huge number of workplace schemes, including Nest and the People's Pension, which are two of the popular ones, they'll use a default strategy for clients, which is known as lifestyling. So what this strategy does, it automatically adjusts how your pension fund is invested over time based on whatever date you plan to retire. So in the early years, with some way to go to retirement, your fund will largely be invested in an adventurous manner. So that's mainly going to be in assets that have high potential to grow, like stocks and shares, for example. As you approach retirement, your pension fund will gradually reduce its investment in stocks and shares, which we've seen on the previous slide can be very volatile. And in their place, safer, less volatile investments such as gilts, bonds, and cash strategies are likely to be introduced. Although this limits the potential growth within your pension fund, it also reduces the chance of any unwanted shocks and big drops in the value of your fund. So a typical example of this approach is shown on the slide. You can see that the individual in the earlier years is heavily invested in higher risk investments. And as their retirement nears, the strategy is automatically readjusting how they're invested and taking them out of some of those riskier investments. The key here with this process is the automatic nature of it, It's not something that you need to manually adjust constantly, which is why it's really popular particularly with big workplace schemes, because it's not very admin heavy and it doesn't involve too much human intervention. However, all lifestyle plans invest with a different intention at your retirement date. So some will expect you to take your fund and buy an annuity. Some will expect you to leave it invested and draw from it gradually, which Jamie showed an example of earlier. And some might even expect you to take it all out in one go. So if the strategy of your fund and your actual plans don't tie up, then you're potentially limiting the potential of your fund and limiting its growth. Also, if your plans change during your working life and the retirement date you've chosen doesn't reflect the retirement date you've got on the plan, then the investment strategy will be unsuitable, which again can be a limiting factor. These strategies also don't pay any regard to your individual attitude to investment risk and how you want your fund to be invested. So while for many these fit the bill as a default strategy, it's really important to review them and consider if things can be done in a better way. And that brings us on to our investment process. So we now invest over £110 million of clients' assets. So it's really important we have a very consistent, strong and well-tested investment process to back that up. The first stage of our process is to complete a psychometric risk profiling questionnaire, which will bring you out somewhere between 1 and 10 on the investment risk scale. And no two clients are the same, so it's vital to get a grasp of this at the start of the process. From there, we subscribe to a service called Dynamic Planner, who provide different investments with their own risk ratings. That way, we know that if you've come out as a 6 out of 10, for example, any investments we recommend are also going to be a 6 out of 10, which will be suitable for you both now and in the future. We'll only use investments with at least a 5-year track record, and we review all of the available investments for each risk profile every month to ensure we're using the best available range of investments. For each different risk profile on the scale of 1 to 10, we've built a portfolio containing a number of different investment funds. Excuse me. And each one of these funds is a multi-asset fund, meaning it doesn't just invest in stocks and shares, but it spreads your money across a range of assets, including property, commodities such as gold, oil and gas, and lending to governments and companies. So this is our risk profile 6 portfolio. And you can see that there's a range of different fund management groups who all have differing outlooks on how best to invest your money, which just further spreads the risk rather than just relying on how any one of these groups think that your money should be invested. This approach is a way of diversifying and not putting all your eggs in one investment basket, as the image at the bottom shows. And each fund will invest across a range of different countries and industries, which further spreads the risk. This is often explained with the example you can see on this slide. So if you bought shares in both an umbrella manufacturer and an ice cream company at the same time, when it was raining, you'd be selling your umbrellas, but not selling any ice creams. And when it was sunny, you'd be selling ice creams, but no umbrellas. The net effect is to get an average return of the two, which means you'll benefit regardless of what the weather is doing. So it's important that we don't just invest in assets which will all rise and fall together, and instead that we diversify and spread your risk. So if we think back to the topsy-turvy graph of the stock market that you saw earlier, our multi-asset approach can help protect against big drops and big dips by spreading your money across different assets, in the hope that when one thing isn't doing so well, then something else in the portfolio will pick up the slack. The benefit of our approach was on show during 2020, when despite the global pandemic and turbulent markets, all of our clients' assets grew. And you can see just how much each of our risk portfolios grew over 2020 on the slide. But we're constantly measuring our performance against peers to ensure we're meeting expectations. And we discuss this in detail with clients. And it's not just a case of cherry picking good individual years of performance like this one on the screen. So as an example, again, using our risk profile 6 portfolio, you can see from the graph that we've outperformed our benchmark by almost 27% over the past 5 years. And what this really highlights is the importance of making sure that your pension is invested in the best way possible. And that's why you should get in touch for a review. So we looked earlier at how extracting money from a business through pension contributions is the most tax efficient route. But business owners watching may think that tying money up in a pension might not be practical for the business and for ongoing cash flow. Or they may follow the old adage that their business is their pension and will fund their retirement. However, with changes to entrepreneurs relief, which is now business asset disposal relief, it's becoming more important to consider additional means of extracting value from your business while you can, which is where a number of pension solutions exist that can help, which are namely SIPs and SASs. A SIP is a self-invested personal pension, which is an individual pension, while a SAS is a small self-administered scheme, which is a workplace pension and can have multiple members. And schemes of this type are usually used by directors of the business. So let's look at an example of where this structure can be useful. Once again, using ABC Limited, they have £50,000 within the company, and they've identified a factory that they would like to purchase to use, which is valued at £50,000. Rather than purchase this property outright, the company could make a pension contribution of £50,000 into a SIP or SAS and purchase the property through the pension scheme. ABC Limited would have use of the property for the business. It would be held within the pension fund, and the business would then pay a commercial rate of rent into the pension. So why would you do this rather than just purchase the property directly through the business, particularly considering that the funds are already available? The first reason is that if the property rises in value, there's no capital gains tax if it's held within the pension. Another reason is that rent is payable into the pension, which is just another way of extracting money out of the business. Rent also doesn't count towards the £40,000 annual allowance. So you could have rent and normal pension contributions both coming out of the company into your pension. Also, if you already owned that property, either personally or through the business, you can buy the property through a pension fund and release that capital to be used by the business or personally if that's needed. There's also no income tax on rent when it's paid into a pension, whereas if you're owning that property personally, you might be liable to income tax. And then finally, and probably most importantly, having the property held in the pension reduces risk. So it's ring fenced from creditors. If the business was to run into difficulties, the creditors could not force that building to be sold to pay the company's debts. Let's look at a second example, perhaps where the business doesn't have all of the money available to buy the property. So again, ABC Limited with 50,000 in the bank, but this time the property they want costs 75,000. One of the directors has a pre-existing pension scheme, which is conveniently worth £25,000. They can transfer this into the pension along with the £50,000 and use the combined proceeds to purchase this property. Again, rent would be payable by the business into the pension. A SIP or a SAS can also make use of borrowing. So using the same example, rather than transferring an existing pension to fund the extra £25,000 cost, the SIP or the SAS could have borrowed £25,000. This might be via a mortgage from a high street bank or lender, or it could even be from the company itself, although that wouldn't work in this example because the company doesn't have the money to make the loan. But up to 50% of the net assets of the pension fund can be borrowed, which is £25,000 in this example. And once again, rent payable by the business into the SIPP or the SAS. And the final example on this topic is one which will only apply to SASs. So as I mentioned, these are workplace schemes. So they're attached to a company and they can have multiple scheme members. So let's consider the business has found a factory, but it's worth £500,000. Director 1 is able to transfer an existing pension valued at £50,000. Unfortunately, another of the directors has an existing pension which is valued at £450,000. They could both transfer their funds into the workplace SAS and purchase the property that way. But note that the different directors have different shares of ownership within that SAS. So if the factory's value rose to £1 million and was then sold, Director 1's share of the proceeds would be £100,000, while Director 2's proceeds would be £900,000, just because of the split of what was paid in. And the same conditions apply, that rent would be payable. So just to quickly summarise on SIPPs and SASs, because these are fairly complex vehicles, commercial property can be purchased, residential property is not permitted. A SIPP or a SAS can access borrowing, such as a mortgage, which is limited to 50% of the net value of the pension fund. So a fund with a value of £200,000 could borrow £100,000. A SAS is a workplace scheme and so can have multiple scheme members. And this can help spread the cost of funding, as we saw on the last slide. And it can also reduce the costs of administering the fund by spreading it across multiple members. As we saw, existing pensions can be transferred in to bolster the value and the funds available. And also the property doesn't have to be one that's linked to the business. So if you like the idea of having some or all of your pension fund invested in a commercial property, then you can purchase unlinked properties. And then you've also got all the normal range of investments accessible, just like any normal pension fund. So shares and funds and that kind of investment. And also something I've not mentioned is that a SAS, and just a SAS, can make a loan back to its sponsoring employer at 50% of the net value. So if the company needed money for a project or to purchase anything, they could make a loan from the company pension scheme back into the business. And so long as they were paying a commercial rate of interest on that loan, they could access the capital that way. So as we sort of reach the end of the presentation, it's important to consider what happens at the end of our lives with our pensions. As we've already seen, pensions are very tax efficient, and it's no different at the end of life. The value of your pension fund is completely outside of your estate for inheritance tax purposes and won't be subject to IHT on your death. We often find that clients might have significant wealth and assets within their estate that would be subject to tax. So they can benefit from, rather than drawing on their pension funds, instead leaving them untouched and spending the assets that are in their estate to bring that estate value down and to limit the inheritance tax that they're going to pay. This then leaves the pension fund intact, which can be passed on in a very IHT-friendly way to the next generation and beyond. If you have an existing pension scheme, it's really important to ensure that you have a nomination of who you want your fund to pass to in the event of your death, just to help your pension be distributed in the way you want when you die. This is particularly important if you have a long-term partner but aren't married or in a civil partnership, just because your pension might not be distributed how you intend in these scenarios. And then also briefly, just a note on the tax treatment of pensions. If you were to die before age 75, the value of your pension fund can be passed on to your beneficiaries completely free of tax. They can draw on it as they see fit, again, with no tax charges at all. And they can even leave it untouched to pass on to the next generation. If you were to die after 75, the pension would still be passed on, but it would be subject to income tax whenever the beneficiary draws from it. So as Jamie showed earlier, this could be done really gradually to minimize any tax payable. And theoretically, if you just drew up to the personal allowance, you could gradually take that fund without paying any income tax at all. So thank you for listening. I hope this has been useful. Apologies for the minor coughing fit halfway through. I'm just going to now pass you back to Catherine, who I think has got some questions and answers.
Thanks, Nick, and thanks, Jamie. That's really interesting. Thanks very much for that. Just looking at some questions that have come through. So we have had someone just ask whether the budget has impacted upon anything in the financial services sector.
Hi, Catherine. I'll take that one. Fortunately for us and our clients, the budget, there was nothing really mentioned around pension planning. We already knew that the lifetime allowance was frozen at the £1,073,100. All of the annual allowances stayed the same. Nick did mention it in his presentation to say that it has created a better opportunity for business owners, as with the introduction of the health and social care levy, just makes it more attractive for business owners to now contribute into pensions. But aside from that, clients came away unscathed from the budget, which makes our life a bit easier.
That's great, thanks, Jamie. One question that's come through: 40% tax rate payer never claimed the additional 20% relief. Can this be claimed or backdated?
Happy to answer again. Yes, so the way it does depend on how your pension is established, whether it's a workplace pension or a personal pension, but higher rate tax relief can be reclaimed for a period of up to 4 years. If your workplace pension does operate via salary sacrifice, then this should automatically be accounted for in the calculations. But if it is personal contributions that you're making, or your workplace pension operates at think a relief at source basis, then it is something that you need to do. But if you have any questions and would like us to review that, then don't hesitate to get in touch, and we can help you with that task.
And just to add something on that, it is really important that you reclaim that tax. We've come across clients who are accountants, not of this firm, I will add, but who really ought to know better, who for years haven't been claiming that higher rate tax relief. So if you don't manually reclaim it, then eventually it is lost, although you can reclaim back, as Jamie said, for various years.
That's great, thank you very much. I don't think we've got any more questions that have come through, so I'd just like to bring the webinar to a close. Many thanks to Jamie and Nick for their time this morning and for that very informative session. We really hope that you found that useful. Just before I go, there is a survey, a very short survey that will appear at the end of this webinar. We'd really appreciate it if you could give us your feedback, just so we can make these sessions more useful for everyone going forward. That's great. Thank you very much for your time again this morning, and take care.